Hello, everyone, and welcome to BFW 2401. This is week 7, and we are talking about credit risk. Just to give you some overview before we start, credit risk is divided into two parts. In week 7, we will study the credit risk for a single loan. And because we have a portfolio of loans, then we have also credit risk for portfolio. So in week 7, we'll just study the single loan credit risk, and in week 8, we will talk about the credit risk portfolio. Now, in week 7 also, we will divide this week into two parts. I don't think they are long parts. I think we will go over them in a reasonable time. So please follow with me, and hopefully we can finish it in reasonable time. So if you allow me now to go to the screens. So this is actually the credit risk 1, and we are talking about chapter 10 in the book. Now, some of you may say, where is this chapter 10? Actually, let me start first with the map. And this is the map of our unit, as you can see. I'm just trying to show the map of what we are doing. And today, as you can see, we are talking about week 7, which is this area, and we are talking about single loan credit risk. Now, if you want to, if you have the book of Long et al. 2015, you can look at chapter 10 and chapter 11. I already summarized them here. Hopefully, the PowerPoints, which is these slides, and the tutorial and the recording should be enough if we cover it and if you study it well. Now, let me go to the learning objectives. So I summarize the learning objectives here, and the learning objectives, as you can see, we are trying to study first the importance of credit risk, which is this part. Now, then after that, we'll go to the loan pricing and the loan pricing of credit risk. And then we will study also the models of credit risk when we do something called the benchmarking. And I will explain this as we continue. Now, under the importance of credit risks, credit risk is a very important when you talk about banking. Actually, it's the basic concept behind the financial intermediation and the basic function of the financial intermediaries like banks. Now, banks' functions have been developed, and they are trading in the market. They are working in derivatives. They are doing so many things. But the basic things they are doing is providing loans to businesses, to the government, and also personal loans to the public. And when they do that, there is always a risk that the loan holder or the borrower will not pay back. So the credit risk is actually the defaulting of payment of the principal when it is mature, or the interest when it is due, or both the principal and the interest. 60% today of bank total assets is coming from loans, and you can see this maybe across countries. We will also want to talk about the type of loans. And the type of loans, if we divide them, we have business loans, and these business loans have their own characteristics. We have a big category now, improving and growing over time, at least for the last 2 decades, which we call it housing loans. So we have the business loans, we have the housing loans, And we have the consumer loans. And when we talk about consumer loans, we talk about personal loans and credit cards. You can talk about automobiles loans. You can talk about any other personal loans. You can talk about, I mean, the main thing, which is the credit card. Now, the models, when we are going to study them, actually, these models, we have qualitative models, and we have the new one, which is based on what we call credit scoring, quantitative models. The quantitative models is based on something called credit scoring. And credit scoring is actually you have to calculate a score for each application without even seeing the customer. Customer can send the application online, or you can go to the physical bank and fill the application. But actually the data and the information stored about this customer will be developed in a model, and the model will create a score. So they will take the age of the applicant. If we are talking about personal loans, like a credit card, they will take the age, the income, the profession, the say if you have taken loans before or you haven't taken loan before. They will look at the history of the loan, of your payments. They will look whether the customer is owning a house or not owning a house, owning other assets or not owning other assets. And after all of those, actually, they will calculate it, the system will calculate it, and they will put a benchmark. If the applicant meet that benchmark, he will be granted by for the loan. If not, it will be rejected. And now we are talking about personal loans, but in business loans also, we have the same scoring, but we are not using the information of the managers as personals. We are taking the balance sheets and the income statement and the financial reports and try to develop a benchmark based on that. And we call this, we have called old models, and we have also new models. Having said that, let me go now first to the to what we are going to do. This is actually what we are trying to do in this chapter. So the importance of loans, it's actually 70%, 60-70%, but it's 70% for Australian bank assets. The management of this lending and the credit risk actually decide and help us in knowing the bank performance. And actually it has a huge relation and big relation with the shareholders' value. Less credit risk means higher share holders' value or bank value. Lending is important because it decides on the profits, but it involves credit risk. We include a risk, which you call it credit risk. Lending is very important for domestic and world economy. We have to do it all the time. We have seen huge credit risk during the financial crisis. Actually, that subprime, when they decided to give the loans for people who are not qualified to take the loans, called the subprime. And we have what we call the credit risk in that time. Credit risk was actually an important factor in the global financial crisis, which we saw in 2008. This is the 2008 crisis. I think we have introduced ourselves last time to something called trading book and banking book. Now, the banking book is all those assets that hold in the bank till maturity, including loans. So when we talk about loans, they are actually, loans is actually here coming with the banking book. Now, the trading, which is the bank can trade and go and buy bonds and stocks and sell them. And the next auction, maybe the same day, the same week, we call this trading book. So we have banking book and trading book. And I think we have talked about that in week 2. Now, types of loans. We have actually those 4 categories. We have the commercial and industrial loans, we have the housing loans, and we have the consumer loans, and we have actually other loans. Now, for the commercial loans, actually, they can be through syndication, and maybe this is a new term for you. Syndication is when a group of banks decided together with each other to grant a huge loan. Say it's like a government loan of 50 billion. So they will divide it in this country between the top big banks of 10 billion. And this is how they can make the loan. You can give also a loan for a corporation, huge loan, and this huge loan will be actually given by all those banks. So we call it syndications. We have another classification called spot loans. Spot loans, when you go and you take the loan and you sign it in the same time. And we have something called loan commitments. This is a promise. This is actually future loans. Future loans, you take the contract now and you will pay it in the future. So this is the future loans, but actually they are promised to be given now. So this is a future loan. And we have seen decline in this category, which is the commercial and industrial loans. And the reason is those huge corporations, instead of going to the financial institutions and taking loans, they can go to the market, they can issue bonds and stocks, and they can issue also what we call money market products like CDs, like commercial papers, and they can become issuers and borrow from the market. So we have been seeing a decrease in this category because as long as the financial market develops, it's another gate or channel to get money, and you get it from the public directly. Real estate is a very big category in bank loans today. And we have one called the fixed. We can grant it in fixed, or we can grant it in adjustable rate loans. And actually, this is what we are giving. Most of the loans in this country is actually adjustable rate mortgages, where they give you the loan, but they keep changing. The rate keep changing as the basic lending rate and of the risk-free changes. So if the government change the rate, which is the basic rates, then you expect this rate to be changing. Of course, it's basis points like what we have seen now. There was an increase just in May of 25 basis points by the government. So every other loan, like those, if they are a mortgage loan, they will increase by 25 basis points, which is a quarter of 1%. Now, mortgage can be subject to default. We think real estate loans are not defaulting because the price of houses always go up. But there will be some time we have witnessed sometimes, especially during the financial crisis, when the value of the loan is becoming less than the value of the house. Also, you have paid for these loans after 3-4 years. You think you have paid, and the loan now is less comparing to the house, which its prices is increasing. But if there is actually housing bubble, like a crash in the housing, then we expect this loan to be higher than the value, less than the value, higher than the value of the house. If the loan higher than the value of the house, then this is actually defaulting. Consumer loans, we have so many of them. We have the personal, auto, and credit cards, and they can be, divided into revolving loans, which means like the credit cards debt, The credit card, you sign only one contract. They will give you in this country 8,000 to 16,000 to 20,000. It depends in your salary or in your income. And then based on that, you have to pay this will send you the statement at the end of the month, and you have to pay it and you start again. You don't have to, they will grant you the 8,000 again or the 10,000, whatever is the limit, they will grant it back to you and you will start, lending until the end of the month. You receive whatever income you have, like salary or business, whatever, you pay it. So it's revolving. But we have non-revolving, which means it's one-time loan. It's not repeated, like automobile loans and any other personal loans. You take the loan, after you pay it, if you want another loan, you have to sign a new contract and go to a new process to receive this loan. And we have, of course, another loans, big loans, like they go loans to farming. We can lend to other banks in the interbank market loans. So there is loans among banks, especially for short term. So that is the interbank market, and we can give also government loans.